Welcome to the latest Should I Fix video, where we look at the cheapest variable rates and compare them with the cheapest fixed rates, and then look at the forecasts over the next few years to see what the potential difference would be. Now, the purpose of this video is not to tell you that you should fix or you should not fix. It's more just to give you an additional thing to think about when making your decision. So for example, let's say you've got a potential change in circumstances coming up. Maybe you're expecting a child, maybe you're starting a business, maybe you've taken on a large mortgage that is really going to make things tight for a period of time. You might decide to lock in your rate because you want to know exactly what you're paying. And if you compare them against the forecasts and what might be available as a variable rate, it might then help you determine, well, how much could this cost me and is it worth it or not? So for example, if you have a 1 year fixed rate and it's going to cost you $2,400 extra in interest, and by the way, these are based on forecasts which are wrong all the time, but you can say, all right, well, it's going to cost me $200 a month to lock in my rate. I think that that's money well spent because I really need to know what the next 12 months are going to look like. So what we do is we use a $680,000 mortgage. We look at the cheapest variable rate. So this is a basic rate at 5.84. We look at the cheapest fixed rates for 1, 2, 3, 4, and 5 years. And then we look at the interest over that corresponding period. So let's start with 1 year. And we are updating the forecasts now. I look at the Westpac forecasts. They're usually the closer to being accurate. And when I say that, I mean, they're wrong all the time, but Westpac seems to be the least wrong, if that makes any sense. I don't know if that fills you with any confidence, but they tend to be the more reliable one to use. So they're saying that there's going to be no rate increases for the next 12 months, which is great because last time they were saying 2 rate increases. So hence, you know, if you watched this a month and a half ago, they were completely wrong. So hopefully they're right. And if we look at a 1 year fixed rate, you're looking at about a 6.19% interest rate. So if we say that you start at 5.84 and you're at 5.84 for the entire 12 months, compare that to the fixed rate and you're at 6.19, the difference between the interest that you pay over 12 months is the fixed rate will be $2,580 more expensive. If we switch that to a 2 year fixed rate, it's closer to about $46.60. So just say a couple of $100 a month. So once again, you say, well, I really need to know what the next 2 years looks like. I don't mind paying a little bit extra. What's the cost? Well, there is the cost based on the forecasts. Now, 3 years, they're saying no change. I highly doubt that. But if that is the case, you're about $7,300 worse off. But you do have the 3 year fixed rate being one of the cheapest. So the banks are kind of putting their money where their mouth is. In other words, they're saying, hey, we really think that rates are going to probably continue to come down on average. So there is a rate rise forecasted in September next year, but then very quickly 2 rate cuts. Personally, in case anyone asks my opinion, which usually they don't, I think we're probably going to have a couple of rate cuts early next year. So I actually think that there's probably a worse economic situation we're in than what is actually their numbers are showing, but I could be completely wrong. I think what's going to contribute to that is I think that some of the wars we've got going on are going to normalize, and what I mean by that is the Strait of Hormuz may not open, or it might have a limited opening. I think the Russia war is actually a lot closer to ending than what a lot of people are saying. I think that a lot of countries across the world are trying to look at other sources of oil, and so I think that we're actually going to have a big collapse in the oil price personally. So we'll see what happens, but that would usually lead to a rate cut, or at least, or even a series of rate cuts. So hopefully I'm right. And then you've got the 4 year fixed rate. Forecast doesn't go into the 4th year, so I'm just using the same rate as where it cuts off after 3 years. And that's saying it's going to cost you 16 grand, and 5 year fixed rate will cost you about 21,000. So like I said, don't use this as your be all and end all of what you should do. You just add this to the conversation in terms of what you might like to do and how much it could cost you. But what's most important is you choose the right product. With fixed rate loans, one thing to keep in mind is you can be limited with the additional repayments that you can make. Depending on the lender, it's usually 10 grand a year. You can split your loan, so there's options. But also you've got to be really careful that you don't fix for too long and you end up having to pay that loan out. So you want to sell the property, or you're expecting an inheritance or some kind of lump sum, because there can be some break costs. Anyway, all conversations we can have when we're talking about choosing the right loan and structure for you. But if you've got any other questions or need any info from us, please reach out. Cheers.